Shares of Comcast, as we mentioned shortly ago, hitting what are all-time highs this morning. The company, of course, revealing new details about the forthcoming streaming platform we, as in Comcast and NBC Universal, are calling Peacock. Yesterday, the service will launch. It will launch for, by the way, Comcast subscribers on April 15th. Nationwide, though, not until the middle of July. There will be a free ad-supported option as well as 2 premium pricing tiers. Here's NBC Universal CEO Jeff Shell yesterday about the company's streaming content investment.
I'm pretty confident when you combine all of this content with our proven ability to market and launch new products with Symphony, and then what I think is a really smart strategy of taking light advertising and bundling to create this unbelievable experience free for consumers. This is going to be a very successful product and is going to be one of the key elements of growth for NBC Universal going forward.
All right, let's get some reaction from the street, many of whom were in attendance yesterday. Rosenblatt Securities, Bernie McTernan is here with us, and Cowen's Greg Williams also joins us. Bernie, let me start with you. What do you think in terms of them trying to carve out at least this idea that they're not competing necessarily with all the current streamers, but in a different area given the ad support and free nature of the service? And
that's certainly the case. We walked away more supportive of the service than we did walking in. Because first, they're partnering with other cable companies. So Peacock Premium, 24 million subscribers in the U.S. will have access to the service for free. Could have another 16 million with Charter coming on board. And then we also think there's a high floor for the service, too, because only $2.5 billion of OPEX commitment for 2024. That compares to Disney Plus at $4.5 billion. And Netflix, $17 billion next year, maybe going to, who knows how high. But then a lower ceiling as well, because right now it doesn't seem like it's going to be global in nature, so only 30 to 35 million subscribers by 2024.
Yeah, Gregory, give me your perspective, particularly from the financial side. Bernie mentioned, obviously, some of the metrics there. 30 to 35 million subs is what they're hoping for within, let's call it, 4 to 5 years when they get to break even. Is that something that makes sense to you? Are you concerned at all about the spend?
Sure. I think that the break-even is very doable. 30 to 35 million subscribers is very doable, especially if it's free. It's going to be an advertising-driven model for a lot of the segment. It's going to be about monetizing that advertising a little bit higher than, say, Hulu does, because they said $6 to $7 ARPUs, but it's only be 5 minutes of advertising. So they're going to need to do really good targeted advertising in order to get a higher CPM. As far as the financials and overall picture, they said a lot of that in December already. $2 billion investment over the next 2 years, break-even in 2024. So not a lot of things that would move the stock necessarily in the next few days because a lot of that information is already well known.
Bernie, a big question with a lot of these new entries in streaming is how much of it is a zero-sum game, how much of the new business is really just going to be trying to cover for what's being lost on the traditional side. For Comcast, how does that shake through the model? Well,
that's certainly the big question is how much more cord cutting will this inspire? So with media companies, you can extend your reach, and that's why you want to go direct to consumer, but how much are you going to cannibalize the existing part of the business? For the cable side of the house, they only make a 30% margin on video, so it's really, broadband share gains is still a great story for the company going forward.
Greg, on that point, I mean, we're looking at new highs in Comcast. I believe you have a hold on the stock. Peacock is an important initiative. It's going to be taking some money, but what is your overall take right now in terms of where the company is, in terms of the value that the market is ascribing to it?
Yeah, absolutely. Last year, the company performed pretty much in line with the S&P 500. We expect a similar performance in 2020. This first half of the year, Peacock is really not going to be that catalyst. As of yesterday, we know that what we're going to get with Peacock. So now they're focusing on the other investors. Investors are worried a little bit about Sky. Investors are looking at the mobile venture they're going into. And, of course, the healthy broadband market in the U.S. and Comcast's ability to take advantage of that, which we're bullish on. But these are the focuses now, and Peacock is now sort of, I don't want to say an afterthought, but now we can move that aside and focus on Sky and mobile.
Bernie, what are you going to be looking for in terms of penetration of the service once it gets going? Are metrics going to become important here?
Yeah, and so a key question coming out of this is, are we already at peak number of subscribers getting Peacock Premium for free? Because we know video subscribers are going to keep going down and broadband-only subs are going up. But what will that attach rate be of Flex boxes? Because right now you only get the service for free if you're a Comcast video customer or Cox video customer and you have the Flex service with broadband only. So how, with services like Roku out there, how will they make sure that Flex is an important part of that broadband-only household?
And taken all together, does it do anything to mute Netflix's domestic subscribership, or where does it play for Netflix?
Yeah, that's a great question. I think the biggest impact will be on pricing power. You know, with Disney Plus coming in at a lower price than expected, same with Apple TV Plus, Peacock for free to 24, maybe going to 40 million customers over time. That next big price increase could be a long ways off for Netflix, at least domestic.
Are you in the school that Netflix does need to have some ad-supported, lower-priced product?
I think it's going to be tough for them, too, because it would be admitting defeat.
It would be a U-turn, no doubt.
Exactly. We have a neutral rating on the stock, $265 price target, because we expect revenue growth to substantially decelerate from 29% growth last year to 23%, going to high teens. And because of that, we're putting a 4.5 times revenue multiple on 2021 revenue and get to a 265 target.
No doubt it is a different marketplace this year than it was even a year ago in terms of who's out there for Netflix.
One of the secret sauces for Netflix was their distribution. And now that distribution, IP streaming direct to consumer, that's now everyone can do it. It's content that matters the most.